this week's market update, the S&P 500 breaks out to a new all-time record, Brextension shifts attention to a general election, and earnings season delivers better than expected results. November and December are typically two of the stronger months in the investors' calendar as markets embark on what is sometimes called a Santa rally in the run-up to Christmas and breathe a sigh of relief that the historically tricky months of September and October are behind them. Having already risen by more than 20% this year, albeit from a very depressed New Year level, the S&P 500 is therefore offering the prospect of a strong finish to an already strong 2019. The history books show that the markets do particularly well at the end of a year in which the first 10 months have been positive. The US benchmark yesterday hit a new all-time high of 3,040 as investors focused on hopes for a resolution of the nearly two-year-old trade war between the US and China and anticipated a third interest rate cut from the Fed since July. Investors are enjoying a rare cocktail of good news. A partial trade deal is expected to be signed by Presidents Trump and Xi when they meet in Chile next month, a reversal of the summer trade war gloom. Other good news includes the expectation that no deal has been taken off the table in the ongoing Brexit saga, at least for the time being, and earnings season too is turning out a bit better than expected. Put all those factors together and it all feels a lot more positive than it did in the summer when trade tensions were mounting and the bond market was sending out worrying signals about the possibility of recession. The summer was particularly hard on economically sensitive domestic stocks on both sides of the Atlantic, with smaller companies underperforming the blue chips by a wide margin. The pendulum has swung back over the past couple of months as value stocks have outperformed the growth shares, which do well when anxiety is high in the markets. Indeed, worries about the outlook for more defensive names like technology stocks are probably the main reason why the improved market sentiment has only just pushed shares into record territory. One of the main reasons for the market's brighter mood has been a better than expected earnings season. At the start of the third quarter results announcements, expectations were depressed, with profits forecast to emerge up to 5% lower than last year. With about half the S&P 500 by market value having now reported, the consensus is for a modest 1.1% growth in earnings for the season as a whole. We'll know better by the end of this week, which sees a flood of leading companies report. The other principal reason for better sentiment this year has been the change of direction for US monetary policy. The first half of the year was helped by expectations that interest rates had peaked at between 2.25% and 2.5% and would turn lower at some point in 2019. Well, July duly saw the first rate cut, with another following in September, and expectations are high that this week's Fed meeting will deliver a third rate cut to between 1.5% and 1.75%. Whether that leads to a continued easing of policy or simply marks the end of a mid-cycle adjustment is a key question for investors. Back in the 1990s, there were a couple of similar three-quarter point easing phases that extended the economic and market cycle into the dot-com bubble of 2000. No one will want to miss a rerun of that rally if that's how things pan out again this time. The final stage of a bull market is often the most lucrative for investors. Having signalled a mid-cycle pause in the summer, the Fed will probably be keen to strike a slightly more hawkish tone this week, and the economy suggests that it would be justified in taking that position. The US looks unlikely to tip into recession imminently. The IMF is looking for growth this year of 2.4% in the US and 2.1% in 2020. Although job growth has slowed, the American consumer is still pretty confident. This week, the EU agreed to the Prime Minister's reluctant request for a further extension to the process, confirming that the new Brexit deadline is the 31st of January, with earlier departure dates of the 1st of December or New Year's Day also possible if the withdrawal has been ratified in time. Importantly, the EU sent a clear message to MPs that there's no scope for further negotiation of the withdrawal agreement, a warning to the opposition parties in the UK not to try to amend the legislation, but to back the deal as it stands. But attention has now shifted from the deal itself to whether Britain heads to the polls in a pre-Christmas general election, and if so, exactly when that will be held. Boris Johnson's hope for a rapid green light from Parliament for his withdrawal deal, followed by an election to cement his position during the subsequent trade negotiations, was scuppered by a divided House of Commons. Yesterday, MPs refused to back his initial request for an election on the 12th of December after a rapid passing of the withdrawal bill. A plain vanilla pre-Brexit election now looks the most likely option, as support from the Lib Dems and the SNP will be enough to get the simple majority that's needed to approve that approach. Labour is currently resisting an election, despite having spent much of the past year calling for a vote, because it now finds itself well behind in the polls. As one newspaper columnist put it over the weekend, turkeys don't vote for Christmas if they think they're going to get stuffed. Increasingly, though, it looks like they may have to fall in line. Looking ahead to corporate news this week, around 160 companies in the S&P 500 are due to report, including big names like Apple, Alphabet and Facebook. There are consumer names like Kraft Heinz too, and energy stocks ExxonMobil and ConocoPhillips. On this side of the pond, there are plenty of big name announcements too. Already this week, we've heard from HSBC and BP. Still to come are Glaxo, Next, Lloyds, Shell, BT and British Airways owner IAG. On the economic data front too, there's a deluge of numbers out of the US. Tomorrow's GDP report is the first to drop, with a slowdown in the US economy expected to show growth of 1.6%. That's down from 2% in the second quarter. Friday has the monthly non-farm payroll jobs report, with hiring expected to have fallen sharply to 90,000 from 136,000 in the previous month. Unemployment is forecast to have edged higher to 3.6%, but average earnings are penciled in at 3%.